Have you ever wondered how the United States can possibly pay back its trillions of dollars in debt? The number is so huge, it's hard to even imagine. We hear about it on the news all the time, and it sounds like a ticking time bomb. But what if I told you the government isn't really planning to pay it back, at least not in the way you or I would pay back a loan? Instead, it has a much quieter, almost invisible strategy to slowly erase its value over time. Let's break down how this actually works. When people think about government debt, they picture a scene of politicians finally getting serious, slashing spending, hiking taxes, and paying down the principal, dollar by dollar. But in reality, for a large economy like the US, that almost never happens. The real strategy is much more subtle and relies on a concept that is crucial to understand: the difference between nominal debt and real debt. Nominal debt is the big, scary number you see on the news, the trillions of dollars officially on the books. But real debt is what that money is actually worth in terms of purchasing power. And this is where the magic happens. Think about it. A dollar borrowed 10 years ago is repaid today with a dollar that buys a lot less stuff. This is because of inflation. Inflation is the government's secret weapon. When prices rise across the economy, the real value of past debt shrinks. Now, let's say that same car costs $40,000. The government still only owes that $1 billion. But in today's economy, that amount of money represents half as many cars. The debt is easier to manage, not because the number changed, but because the value of everything else went up around it. This process becomes even more powerful when inflation is higher than the interest rate the government pays on its bonds. Economists call this negative real interest rates. It means that even though the government is paying interest, the value of the debt is shrinking faster than the interest is adding to it. So, people who lend money to the government by buying its bonds are actually losing purchasing power over time. Their investment isn't keeping up with the rising cost of living. For the government, it's just like getting a loan where you end up paying back less in real terms than you borrowed. And the best part, for them, this all happens automatically without any big, unpopular announcements. But what happens when the old debt comes due? Does the government scramble to find the cash? Not at all. It simply rolls it over. This is another key part of the strategy. When old government bonds mature, the Treasury Department just issues new bonds to pay off the old ones. It's like paying off one credit card with another. As long as there are people and institutions, both in the US and abroad, willing to buy new US bonds, this cycle can continue forever. Why would anyone buy these bonds if they might lose value? This is where a concept called financial repression comes into play. It sounds intense, but it's really a set of quiet policies and regulations that nudge people's savings into government bonds. For example, rules might require banks or pension funds to hold a certain amount of super safe government debt. This creates a steady, captive market, keeping demand high and interest rates low, even when the real return isn't that great for the investor. From a political perspective, this slow burn approach is a genius move. Imagine a president announcing a 20% tax hike or massive cuts to social programs to pay down the debt. There would be riots in the streets. It would be political suicide. But letting inflation do the heavy lifting is different. The cost is spread out across the entire economy over many years. There's no single bill that says your share of the national debt. Instead, the burden is felt through a gradual loss of purchasing power. Your savings buy a little less. Your salary doesn't stretch as far. It's a subtle and widely dispersed cost, which makes it much easier for politicians to manage. Of course, this process isn't painless. It has real consequences. Savers, especially retirees or anyone holding cash or fixed income investments, get hit the hardest. The value of their nest egg slowly erodes. If your wages don't keep up with inflation, your standard of living declines. Essentially, bondholders and anyone holding dollars are quietly paying for a portion of the government as debt through this wealth transfer. The effects are subtle year to year, but over a decade or two, they add up to a significant shift. And this isn't some new, radical idea. Historically, this is exactly how many advanced countries have dealt with massive debts. Especially after major events like World War II, they didn't default, and they didn't impose crippling austerity. Instead, they relied on a combination of economic growth, moderate inflation, and low interest rates to slowly shrink the debt burden relative to the size of their economy. It's a strategy that relies on time, patience, and stability. The whole system works as long as a delicate balance is maintained. The key is credibility. Investors have to believe in the stability of the US government and its ability to manage its finances. If inflation gets too high and spirals out of control, that trust can evaporate. Lenders would start demanding much higher interest rates to compensate for the risk, and the whole rollover strategy could fall apart. Likewise, if the economy stops growing, the debt-to-GDP ratio, the main metric of a country's debt burden, would start to look much worse. What makes this whole dynamic so fascinating, and frankly, a bit unsettling, is how calm it all appears on the surface. There's no big default, no emergency summit, no sudden crisis. The stock market hums along, bonds are traded, and the government continues to function. But underneath it all, the real weight of the debt is constantly being reshaped. The nominal number on the screen gets bigger and bigger, but its actual burden on the economy is being managed, and even reduced, through the silent forces of inflation and financial mechanics. So, the next time you hear a staggering figure about the national debt, remember what's really going on behind the scenes. America isn't paying its debt in the traditional sense. It's managing it, refinancing it, and, in a way, slowly inflating it away. It's not a dramatic explosion, but a quiet, decades-long process of erosion. Understanding this is key to making sense of how modern economies truly operate. It's less about a single payment and more about a long, complicated, and powerful game of managing value over time. Thanks so much for watching. If you found this explanation helpful, give this video a like, and subscribe for more deep dives into how our world really works. See you in the next one.